Recording now in progress. All right, guys. Glad everybody could make it out today. Let's see if there's anybody else here that's trying to get in. I think we're good. All right, we're going to be talking about veterans loans today. Anybody work with any veterans? You have? Okay.
I'm working on one right now.
All right, well, good. Well, this will be appropriate for you then. So veterans loans are a tremendous benefit to the veteran. They are maligned much in this situation right now with where we're at in the market, but I think they're maligned, falsely maligned, because they are phenomenal loans and they really carry no more risk than an FHA or a conventional loan if they are done correctly. And so we're gonna talk about how some of that works today. We're gonna go through. Let's see if I can get. There it is. All right. So we're gonna go into. Oh, does everybody want to print out? Well, yeah, whatever. Print out.
If you print them, I'll go.
All right. So we're gonna talk about some very specific things here. I'm gonna print off a bunch of these so that we have them for the class. Let's see here, 2 pages each. And we're going to go black and white, and 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. That's off of the camera. All right, so we're going to go into print 7 here, and Danielle is here with us. There we go. All right, back to the PowerPoint slide. So all this stuff is coming. You're going to hit your printouts here in a second. But we are going to be covering the VA loan today. So this is specifically for veterans. It is a tremendous benefit to the veterans. Just so that you guys know that we're going to talk in general terms, general information. We're going to talk about eligibility. We're going to talk about reusing the veteran loan. We're also going to talk about secondary entitlement. We're going to talk about VA jumbos, VA loan types, the funding fees. Once again, the AUS system. Does everybody remember the conversation about the AUS system? We're going to come back to that again, and we're going to beat on this AUS system because it's that important. Okay. Talk about qualifying ratios, significant credit information, and events, and then also how appraisals work with this type of loan. This is pretty important stuff. Now, back at the turn of 1900, the VA loan did not exist. It wasn't until after World War II that the VA loan actually came out. We had all these veterans coming back from overseas. They had given so much for our country, and there was no program for them. There was nothing designed for the people to be able to come in and actually buy a home with a significant benefit from the U.S. government. In fact, what's interesting about it is about 10% of the population is actually a veteran. That's a really big number. Now, if you start working a little bit more towards Blackstone, or you're working down towards Fort Lee, or you're heading a little bit further out west towards New Kent, down towards Virginia Beach, you're going to start having a much higher concentration of veterans. And so learning how to use some of these, in fact, one of our, up in DC, the VA loan is tremendous. I mean, they're just doing VA loans like crazy. So it's a big deal. It's a big part of our demographic, and it's certainly something worth being familiar with when it comes to this. Now, the general information about the VA loan is specifically along these lines. VA loan is specifically going to be full documentation. Now, what full documentation means to you is that we have to prove beyond reasonable doubt that the veteran is able to repay this loan. So it's not a loan where we can just kind of wink, wink, say we got so much income. We actually have to prove it. The level of proof that is required is the same level of proof that would be required in a criminal law investigation. So in other words, if you're going, and this is the same thing for FHA, this is the same thing for any of those other loan types, we have to prove as if it were a criminal investigation that these people have the ability to repay this loan. So what does that mean? We call it belt and suspenders. Okay, so by belt and suspenders, what I mean is this: we have to have a pay stub, but we also have to contact the employer to verify that that's legit. Okay, Then we also have to look in the bank statement to see that it's actually being deposited in there. Okay, so now we're going into multiple levels of trying to make sure that all this stuff is working and that we have the ability, it's called the ability to repay. The beautiful thing about this loan type is that this loan type does not require any down payment. There is no requirement for a down payment on these loans. That is a wonderful benefit to anybody who is looking to buy a house as far as a veteran is concerned. Now, if they do pay a down payment, their terms get significantly better. We're going to talk about that as we go down through the process. These types of loans are only available for owner occupant. You're not going to be able to buy it as an investment. It's only owner occupant. Now, having said that, if they already own it and they have owned it as a veteran, if they've owned it as a veteran and they've left that house and moved into a new house, they can still refinance that property under the VA, which is a very rare thing. It's not something that can happen all over the place. They can still do that. That's something extremely important to know. The VA loan is also one of the few loans that is fully assumable. So what that means is, let's just say John is a veteran and he wants to sell to his cousin Joe. And Joe comes in to John and says, I want to go ahead and help you buy this house. And by the way, I'm just going to let you take over where I left off. That's what an assumption is. So let's say he bought the house for $300 and he only owes $260. Joe's taking over at $260. That's what the assumption means. Now, if they want to do some horse trading in the background and Joe gives John his Bronco in exchange for that $40,000, then that's something you can do, or his tickets to the next football game or whatever you guys want to decide. You guys can do that, but the assumption is to be taking over where that person left off. Not necessarily a bad thing. The beautiful thing, this is where the benefit truly is to the veteran. There is no minimum credit score. You can see that right there. There's no minimum credit score set by the VA. However, that doesn't mean that there is a lender or an investor, because the VA does not actually fund these loans. The VA provides the funding for these loans, guarantees them, but they do not actually do the funding. The funding is actually done through the bank itself. And so here's what that means. The lender typically is the one who sets the minimum score for lending. Okay, now, theoretically speaking, I can do alternative credit for a veteran, and I have done it before. Okay, but right now during COVID, everything's gotten really tight, so it's very difficult to do that with a veteran. Now, what is alternative credit? Has anybody ever dealt with alternative credit before? Okay, alternative credit is something that doesn't show up on your credit report at all. So in other words, you've got a 0 credit score, you in essence don't exist in the credit world. But you may have a gym membership. You're paying your car insurance. You have a contract for your cell phone. You have a contract for your Verizon or Comcast or cable or internet or something like that. You're paying rent somewhere. I can use those items and convert them into a credit score. Convert them into a way to prove that you are credit worthy. Now, having said that, what ends up happening, what the lenders do when it's like that, even though there's no credit score requirement, what the lenders do is they drop that to the lowest allowable credit, and that's how they set the rates, that's how they set the terms, that's how they set everything. So here's what that means. If at a 740 credit score, your interest rate is 3%, if you have a 0 credit score, they're going to give you a 580, which that credit score now means instead of a 3% interest rate, now you're probably dealing with a 4 or 4.5%. Doesn't mean I can't get you the loan. It just means that it might be worth our time to set you up on a track to help you establish credit so that we don't have to deal with that long term, and you're able to move forward fairly quickly with it, okay? There used to be maximum loan amounts. So this is old, this changed just recently right here. So you can kind of ignore this piece right here. There used to be maximum loan amounts in this area that they would be willing to fund up to. And they still do have kind of a maximum, but it's based off of, the VA has removed that. Now you can go as high as you need to, but what ends up going on with that is it's based off of their eligibility now. And so they look at the eligibility for the area, and the eligibility for the area is based off of their certificate of eligibility, and that dictates how much house they can buy and receive 100% of that benefit. And so what I mean by that is if they're trying to get more benefit, if they're trying to maximize their benefit and get 100% financing, then that's a little bit harder for them than if they're trying to do it where they're willing to put some money down. So I have people many times who are buying homes with a VA loan that are trying to buy in the $700,000 to $800,000 range. They can do that, but many times a VA loan won't fund all the way up to that, so they have to put a down payment to maximize that. Okay, so that's not necessarily a bad thing, but it's certainly worth it. I did one just recently with this exact strategy. So the VA loans will finance 1 to 4 units at 100% of their benefit. So that's what that means is that they'll let them buy this house with 0 down. Okay, that's pretty amazing. I'm going to tell you, because I just did this for a guy down in Hopewell. He bought the duplex, and he was living at Fort Lee, and he's a military guy. And so he's going to live in one side, and he has the other side rented out. And he got 100% benefit for it. It was awesome. He can use that one side that he's not living in. He can use that side to help offset the other side, and it works tremendously well. It's a very good way to go. Modular or manufactured homes are a little bit harder to get done, but they are a possibility should that be a case. Okay. Let's see, Peter's, all right. Peter's coming in. Hello, Peter. All right, so the eligibility is extended to active military, and it's extended to anybody who has been inactive or has served 180 days during peacetime or 90 days during war periods. So this is mainly for the veterans themselves. That includes the National Guard. That includes several other places, but there's a different view. That doesn't include the National Guard, I'm sorry. That includes the Coast Guard. The Coast Guard, the Army, the Navy, the Air Force, the Marines. Now, if you're going in as a reservist or if you're going in as a National Guard, that timeline changes significantly. You have to have 6 years. And so that changes how we have to look at it. So just because they tell you they're a veteran, we have to start asking more qualifying questions to determine and to verify what is what with each one of these items. Okay. And so, and going down into a little bit more, let me just throw this somewhere. It's so distracting to have 6 phone calls right in a row. All right. Now, the spouses, believe it or not, this benefit for VA does extend to spouses as well, but only spouses of people who have died in the line of duty. And so what that means is if you have an Iraq War veteran who passed away in the line of duty, his spouse would be eligible to be able to go forward and to be able to buy a home with that type of loan as well. And or as a result of a service-related disability. So here's what that means to you is I had a gentleman who actually bought a home and he was bound to a wheelchair and could barely talk. And it was all related to something that had happened while he was in the military. And he bought the house. He had a tremendous pension, had a tremendous whatever through the VA. Okay, his wife inherited that after he died. She was able to go forward and use that to be able to buy the house, to refinance the house, or to do whatever she wanted to do with the house, because I think it was something related to the Vietnam War. I couldn't tell you exactly what, but that's when it all happened, and it worked beautifully for them. It's a tremendous benefit to them, and surviving spouses as well, and then other public service health officers, midshipmen, Naval Academy, stuff like that. Now, the way that the VA works is, once again, the VA does not actually fund the loans. They guarantee 25% of that loan. And so what that means to you is that if they're buying a house at 400,000, they're guaranteeing the bank that that person at 400,000 is good for that 400,000. They're going to guarantee the losses of that 100,000, which would be the 25%, should the borrower default on a loan at any point in time. Now, once they've paid it down and got past that, then obviously the VA is off the hook. But until then, they are guaranteeing that this veteran is able to do that because they've set it aside. Now, there is something that goes with it. It's called a funding fee or a guarantee amount. In other words, they're paying into this fund in case somebody does have it happen. We're going to talk about that here in a couple of seconds. But that's why the lender, as you can see right here down at the bottom, they're accepting no down payment, because if the loan defaults, the lender will reimburse the VA up to that guaranteed amount. It's a pretty cool eligibility thing. All right, going into the next one, reusing eligibility is actually a very common question that I get. I've had veterans say, well, I don't want to use my VA eligibility right now because I want to use it when I want to buy the real house, okay? And so they're saying, like, I just want to take advantage of that benefit. But here's what they many times don't understand. Once they sell the first house, they can reuse and rinse and repeat. They can keep going. Or if they bought the house, the first house with the VA, that refinance it into a conventional, they can use it again. Or if they bought, let's say in San Antonio, and now they're moving to Richmond, as long as they have enough of that 25% guarantee, that entitlement left, they can bring that over here and use it here again and have two VA loans, one over in Texas and one over here. So they have a lot of options able with this VA loan. It is a tremendous benefit to them to be able to buy a house with this VA loan. Now, once they sell their house, it reestablishes their entitlement. So they can go right back out and reuse it again multiple times.
When you, words off my head, but assume a loan, like I assumed a VA loan, and to this day, I mean, it is now paid off, but forever, I got phone calls, do you want to refinance your VA? So did the original owner still have connection to it, or after I assumed it, it was not?
No, they're still connected to it.
They're still connected.
It never comes off of their
Until
entitlement
it's gone.
until it's either paid off or you refinance out of it. So that's the downside of the assumption program. Is that if you assume somebody else's loan, it never comes out of their name in essence. You may be the one that's legally liable and everything else, but their entitlement continues to be tied up with that house until you either sell it or refinance it or pay it off.
So they are tied.
They are tied.
That's like their original.
If you assume it.
Right.
That's why I encourage people not to let people assume loans. Is why would you want to tie up your eligibility with somebody else? Okay, just think about it. Okay. All right. So the loan is assumed, substitution of eligibility. All right. So they have, when they assume that, they have to do a substitution of eligibility. So there's two ways that the VA loan can be assumed. It can be assumed through another veteran. So if another veteran is assuming that loan, then the eligibility transfers from the departing person to the person who is the new veteran on the file. However, if the second person, the person assuming the loan, is not a veteran, it continues to tie up their eligibility. Okay. All right. So the math right down here, here's the math for simplicity purposes of how they're going to guarantee this. And so 500 conforming loan limit, the max guarantee is 25% of this amount, so they're going to guarantee up to 125. Now, you can see here on a $200,000 original home, they're going to guarantee $50,000 of that $200,000. Now that means, look at this, there is remaining eligibility there. Does that make sense? There's remaining eligibility. So if they decided not to sell this house and to go into another one, into another location, they're moving from Richmond to Texas, they can use the difference between these two when they go to the next phase. Now, that doesn't mean it'll be 100% financing, but they can use it. Does that make sense? Okay. So then here you can see the buyer can then purchase, and that's what this is right here. That's saying that this is in essence what they can do. They can purchase a $300,000 home with no money down, 75,000 times 4. Okay, if the sales price is $320,000, now they have to put some money down in order to be able to stay within that eligibility. Did I lose everybody? Very good. Okay. Dan is back. All right, moving on. So VA jumbos, this has changed a little bit. They are definitely willing to go up to the VA jumbo, but it's all about the eligibility that you have left. And so if they're going to take a jumbo, they're going to look at the total purchase price of the home, calculate how much eligibility you have, and then they're going to go ahead and offer you the opportunity to get as much of that as possible finance when it comes to this. Now, the only reason you'd really want to use a jumbo VA is if you have a service-related disability that waives your funding fee. Now, we're going to talk about that in a second, because actually, while I'm here, I'm just going to go ahead and talk about it. The funding fee can be fairly expensive. So if you have a funding fee on a VA, the funding fee is 3.6%. So 3.6% times 700,000 many times is more than it's worth to go with that VA loan. Now, if you have a service-related disability, then at that point in time, it's all waived, and it's not a big deal. Okay, but with a service-related disability, it works out for you, but it may not necessarily work out if you have to pay that 3.6%. Many times, if you have the money, you're able to go with a conventional loan at that point in time. Okay. Now, the funding fees go down based off of how much money you're putting down, as well as if it's your first time use or so on and so forth. If it's your first time use, that funding fee goes down significantly. So how do you prove eligibility? So we actually have to contact the VA when we're dealing with eligibility on a veteran. The reason why this is important for you is because if they come to us and they say, hey, I've been in the military and I get a VA, and I've had this happen before, okay, where somebody comes in and says, I'm a veteran, I want to go ahead and do this, I want to go ahead and use my VA loan. Well, we have to contact the VA in order to get the certificate of eligibility, because we don't know how much entitlement they have until we have that certificate. I've had the certificate come back where they've lost a home to foreclosure and they have zero entitlement left. And what that means is that they're not using the VA. They're just not using the VA. Okay, I've also had it where it's a first time use and they send me their DD-2114, which is separation of service. And that form shows that they were dishonorably discharged. Well, guess what? They're not getting it either. Okay, and so we have to, there's nothing we can do. Now, we still go ahead and pull that because we want to do the justice to the veteran. We want to do the justice and do the right thing for this veteran and make sure that we get it. Okay, so we're going to pull it and see when it says when the certificate of eligibility comes back in. Because sometimes they were medically discharged, other things like that, they may still get it. I've had people who got hurt in boot camp, like significantly hurt in boot camp, and they did get the eligibility, even though they weren't in there that long. Okay. For the National Guard and other vets, there's a different form. This is the National Guard version. And then there's a services statement for those who are currently in it. I'm dealing with one right now who is an active service member. They're not going to have DD-214 right now because they haven't been separated from service. And so we would have to get the statement of service in order to make that happen. We then go and take that information, we input it into right here, and then we have a request for a certificate of eligibility. And then that pops out the certificate of eligibility so that we know exactly what to use. The veteran themselves can actually do this if they want to. If they want to see where it's at, they can go right there. We can do it as well. It's pretty instant. If we go into the website and we pull it down with just the basic information, we can have that certificate of eligibility back within 5 to 7 months. And so it's actually pretty nice. The VA loan types that are available, fixed rate tends to be the most popular one right now. They do go in 5-year increments starting at 10 years. So we've got 10, 15, 20, 25, and 30-year increments. We also have temporary buy downs that are possible if you want to do that, but you still have to qualify at the highest rate possible. There are adjustable rates that are also with this. These days with where rates are, right, it doesn't make a whole lot of sense, in my opinion, to go with anything other than a fully amortized 30-year fix. But I have had in the last 10 years, I have had one or two want to go with an ARM loan. I got to tell you, to me, it didn't make sense, but I presented them with the options and they decided to go with an ARM loan. More power to them. You can do some energy efficiency improvements in this, and you can see that right there. Now, those are hard to prove because you have to prove that the energy efficiency improvements, like changing out some windows, adding some insulation, and doing other things like that, are going to provide a certain level of return. And that's just really hard because a contractor is not willing to put their stamp and say, yeah, it's going to provide you with a 15% improvement. And so most of that stuff is really hard to prove, even though it is available. There is an interest rate reduction loan that can happen for the VA. We do a fair amount of these, and these are actually a tremendous benefit. You can see the funding fee is actually reduced to 0.5%. So if you do have a veteran that is thinking of doing a refinance, you don't have to do what's called a full documentation loan. This is actually what's called a streamline. And with that, the funding fee, everything is much more abbreviated. A very good way to go. And they will actually refinance when they're doing this up to 100%, even with cash outs. And so I did one with a gentleman a while back who did a cash out on his house, cash out refinance. And he had like 35% equity in the house. And he wanted to take all 35% equity out, and he refinanced it all the way up to 100%. And he got cash out with it. And this is the only program that allows them to do that. Now, he went out with that 35% bottom of the house, which I'm excited for him. He was able to do that. But that is a strategy that some people can employ. Okay. So here's where the funding fees come in, and this one is a little bit old. You can tell I haven't taught this class in a little while because I have a 3.3%. This actually was raised last year during COVID to 3.6, and that pretty much stayed the same. But this is all pretty much how it works. If you put down more money, it reduces how much you have as far as funding fee. Same thing with reserves, but you can see there's a difference between reserves and the actual military there. There's no mortgage insurance on this. It is slightly higher for a second time use. You can see that. So this is the first use over here. And even though that one's off a little bit, you can tell that it really is, it is a little bit more expensive than that. Getting back to the automated underwriting system. So once again, I'm going to park on this for a couple seconds because I don't think I can emphasize this piece enough. We don't have a loan. Nobody. I don't care if you're with a bank. I don't care if you're with a broker. I don't care if you're with a correspondent. You do not have a loan unless you have an automated underwriting approval through either Freddie Mac or Fannie Mae. You don't have one. It's all about the data points that go into the loan. If the data points are not correct in the loan, it's garbage in, garbage out. So if I put in a bunch of garbage into the data points and I get an approval, once those data points get fixed by the underwriter, I may not have a loan. Does that make sense? And so this is extremely important, especially in the pre-approval process. Understanding where the bank statements are coming from, understanding how much cash they have, understanding where certain things are. And just because they provide me with bank statements, but that doesn't mean people don't spend things along the way. Have you ever had that happen? Okay. I'm actually dealing with one right now where he decided to spend some money. He had $7 grand to do the closing, and now he has $5 grand. And it's like, where did you put the other $2 grand? Well, okay, so now we're short $2 grand, even though the initial bank statement showed that we had the $7 grand closed. Does that make sense? So some of those data points can change throughout the process. But I do need to let you know that in the pre-approval process, you want to make sure that the data points are correct and that you run the automated underwriting systems. And these are extremely important because you have to have their approval in order to get a clean loan to go through. So if you have a clean loan, you've run the automated underwriting system, we can get loans like these closed in about 21 days. We can sometimes back them down to 14 days if necessary. Now, VA loans, you can't because appraisals take longer, but these automated underwriting is extremely important because they look at all the data points and they tell us whether it conforms to Freddie Mac and Fannie Mae standards. And that tells us whether we have a loan. Now we're going to get into the questions you have to ask on these right now. And here are the 3 questions. When you're getting a pre-approved buyer that you don't know the lender from, you need to know these 3 questions. Number 1, have you run AUS and what were the results? Number two, are there any items on the findings that the borrower may not be able to satisfy? Number 3, are there any items in the findings that the borrower may not be able to satisfy? Number 3, do you have any additional requirements or overlays that might prevent the borrower from going forward? When you get a pre-approval letter from a lender that you don't understand, whether you or don't know, whether you're the buyer's agent or you're representing the seller on the house, those are the questions you ask. Because once again, you're not getting a loan through unless you have it.
Run the 3 questions one more time.
Okay, have you run AUS and what were the results? 2, are there any items in the findings you may have a hard time satisfying or the borrower may have a hard time satisfying? And 3, do you have any additional requirements or overlays? That's the word that we use in our little world. Do you have any overlays that the borrower may not be able to satisfy? Now, you have not asked any personal information at this point, but what you have done is, in essence, you have given them the fact that you know what you're talking about. You're a green brain real estate now. You're asking what we would ask. So if Joe came to me, okay, as my loan officer with a loan, I would ask him those questions. I would say, have you run AUS? Okay, what were the results of AUS? Is there anything, have you read through AUS? Do you know what's going on? Do you know, does it match the file? Those are some of the things that if I ask Kara, that's the same thing I'm going to be asking there. Okay, now we don't have any overlays, so I wouldn't be asking the 3rd question. But if you went to like a CNF, or you went to Town, or you went to some of these other banks that are around in the area, they do have overlays. And you would have to ask them if they have any overlays that aren't going to kill the loan, because now you want to make sure that they've compared their overlays and the AUS system to what's happening on this exact file. Okay? All right. If you have not run it, if they have not run it, you do not have a loan. Just let you know, you don't have a loan. You got a wonderful piece of paper, but you don't have a loan. Okay? Qualifying income. So there's 2 standards for qualifying income. There is the qualifying income, and then there's also residual income. And so what that means when we're talking about qualifying income is we have to get them underneath a certain debt proportion. But there is a nuance that is specific to the VA that many times can trip up the VA loans. And I've had it happen to me, confession time. Hi, my name is Chris. Okay, my name is Chris. And I had a problem with this point. Because the residual income has been a problem, because many times you don't need it for conventional, you don't need it for FHA, but you have to have it for VA. With the VA, what you have to do is you actually have to look at child-related expenses. I don't have to look at childcare when I'm not looking at a VA. But if I had one client a while back that they paid for after school care, and then they had a nanny that would come in and take over after the after school care was done until they got home, and then they would do whatever else. Well, that care was over $1,200 a month. That's like another credit card payment of $1,200 for a VA person. Now, in this case, they were making really good money. It didn't matter. Okay, if you have a nanny, that's usually the case, right? Okay, but in this case, it didn't matter. But I've had others who were paying for after school care, and it was only like $150, $200 a month. But that was sufficient to kill the deal. Okay, those are some questions that need to be asked ahead of time, because that's a really big deal, is the residual income. So anytime you're dealing with a VA loan, it's not just about the qualifying income to help them qualify for this house and the debt ratios. You also have to look at the child support or child care, the family support. So if they're sending money to Mexico to help their family, that's part of it. We have to look at that. Okay, so these are big deals of what we have to look at. So it's not just about the qualifying income, but it's also about having a positive residual after it's all said and done. So military allowances we can use. You can see the BAH, or the basic allowance for housing, the basic allowance for subsistence, BAS. These are non, some of these are non-taxable, but we can add them to their income to help them qualify. So these are actually kind of nice to be able to help these. Hazard pay can also be on there. Sometimes that hazard pay does go away. So if they're overseas and buying a house on their way back, we may not use a hazard pay because that will go away once they get back from Afghanistan, Iraq, or wherever it is they're coming back from. Active duty members don't pay any state income taxes, which is kind of nice. And this is an interesting thing too, that the veteran has to do after closing, is many of them have 100% disability through the VA for whatever happened. I know a guy that I deal with on a regular basis that he got attacked in, I think it was Afghanistan, with some sort of chemical agent. And his back, he looks like a leopard. Looks like a leopard. Because whatever chemical that they used on it. And sometimes it'll just cause breakouts on his skin. Well, he got 100% disability because of that through the VA. So not only does he not have to pay a funding fee, but he can go down to the county and he doesn't have to pay any taxes. Doesn't have to pay any taxes for Chesterfield County. Doesn't have to pay any taxes for Henrico County. That's a really good benefit for most of the states. They do have those. So you have to kind of, those are some questions that you ask when you're dealing with veterans, because they may have something that helps them. Now, if they're in active duty, they probably don't have that yet, but if you got the separation of service statement, the DD 214, the certificate of eligibility, when that comes back, that tells us what's going on with that. Additional qualifying information. So interested party contributions. You guys remember who an interested party is? Who's an interested party in any real estate transaction? Well, the realtor would be one, right? Because they get paid off of that transaction actually happening. So they're an interested party, right? The seller is selling their home, so they're an interested party. The lender is an interested party because they're also getting paid from it. Okay? Those people right there, they have a maximum contribution that they can give towards the buyer's closing costs, prepaids, points, closing costs, anything like that. Okay? The maximum that they can give on a VA loan, which is different from FHA and it is different from conventional, is 4%. They have a maximum of 4%. Now, the beauty of this 4%, which is very different with conventional and FHA and conventional, is use it or lose it. With the VA, it's not use it or lose it. If you get that full 4% and they can only use 2% of it, that other 2% they can pay off their car. That other 2% they can pay off their credit cards. This is a tremendous value that you can't get anywhere else. And so if they're coming in with it, now I've dealt with this several times where we had a borrower that was right on the edge. I mean, this was back in 2018 when you could actually get seller concessions. You guys remember those days? You remember those days probably. Okay. When you could actually get seller concessions, this guy had to pay off his car. We asked for 4% back from the seller. He had enough to cover closing costs, but we asked for 4% back so that he could pay his car off so that he could qualify to buy this house. And it worked. Okay, that's the beauty of the VA. You can do that with a VA, whereas you can't do that with FHA or conventional. It's use or lose it with FHA or conventional, whereas the VA, this is a tremendous benefit. So many times cash reserves are not required for the VA, whereas FHA and conventional, many times, I know in conventional they're required all the time. They want to make sure that you have enough to eat after this thing is done. They want to make sure that you have enough to pay the bills, so turn the lights on, to pay the water, to get gas to go to the VA doesn't care about that for some reason. So they're not necessarily having to require cash reserves, so it does make it a very easy loan. As far as gifts, they can get gifts for anything. Literally, if you get a gift from mom and dad and a seller concession and the borrower doesn't come to the table with a dime, even for the appraisal, the VA doesn't care. FHA, conventional, they do care, but it's not as much for that one. So that's a really good, important point to be talking about when you're dealing with VA loans. Additional qualifying information. So this is there are a couple nuances here that are very important for you to know, because we're in a day and age where not everybody gets married right away, okay? But here's the thing, the VA will not allow non-married co-borrowers. They just won't allow it. And so, what's that? They will not allow non-married. If you're not married, you're not getting on a loan for a VA. So if you're single, and let's say I'm not single, but let's say I'm single and I want to buy the house, then I can do that. But if I'm single and I'm, joined with somebody else at the hip, and they're my girlfriend, and we're living together, and so on and so forth, my girlfriend cannot be on the loan with me. Cannot be on the loan with me. The VA is the only one that has that requirement. Okay, they have to be married.
Can they be added to the deed?
They can't be added to anything. Now, we've had people who were getting married in November, and this was January, and I've told them, I tell you what, once you go down to the Justice of Peace, you know you're getting married, go down to the Justice of Peace, just kind of take care of it, and then have your wedding in November. And then you know you're getting married anyway. It's just, for the sake of making this happen, let's just do it. And they went ahead and did it. Now, I've had others say like, no, that's not gonna work. Okay, we're still testing the waters, whatever. Okay, I get it. But the VA will not allow non-married co-borrowers. Okay. You can't have non-occupant co-borrowers on the loan. In other words, there's no co-signers.
So I got a question. So the VA honors the state or the federal guidelines, laws, when it pertains to what defines marriage, right? Husband and wife, gender, you know what I'm talking about, right?
The way it says it is they don't allow non-married co-borrowers. If they're legally married, they're not going to stop it. I don't know how to answer it other than that.
So like common law would be.
Common law is work.
I mean, I know that. But.
Yeah.
Okay.
Yeah, have documentation for it.
Yeah, you got to have something showing it's married. All right. So non-occupant co-borrowers, in other words, mom and dad can't co-sign for junior. They're just not going to let you do that. You have to go with a different type of loan. Borrowed funds, you can't get borrowed funds unless it's from an acceptable source. And this goes back to the same thing for everything else. We have to go through anti-money laundering laws. And so we have to prove that you have the ability to get this money and that you're not laundering money for somebody else to do this. So the money has to be provable that it's yours. You can't get a signature loan for a down payment. You can't get a credit card advance for a down payment. There's a lot of things that you can't do in order to be able to get a down payment or pay for your closing costs. You have to prove that you actually have that money. Okay, you can pull it from acceptable sources. You can do, you can actually get a loan on a car. I've had people do that before, to get a loan off of a car that's already paid off so that they have enough money to be able to go and do this. I've had them do it on a boat. I've actually had them sell items, and I have to prove where that money is coming from. It's very difficult. So if you know they're going to do this, make sure that you always bring it back to the loan officer to talk about, because it's not just taking a picture of the boat and here's the cash on hand where I got it, okay? That's not what works. I have to have a title, I have to have a bill of sale, I have to prove where the money came from, I have to. Okay, so there's a lot of things that I have to do to get in order to make this work. But you can get it from acceptable sources. You can get it from automobiles, collectibles, real estate. I have a lot of people who are doing home equity lines of credit to take money out of their house so they can buy another one. That's acceptable too. The non-acceptable sources would be what are called non-secure. So in other words, I'm just going to get a signature loan, or I'm going to go get a credit card advance. You can't do that. You can't get a loan from mom and dad either. They can gift you, but they can't give you a loan. And so we have to include that. If they decide to get borrowed funds for that, we have to establish a payment based off of market rates. So if mom and dad give them a loan, but there's no payment, we have to establish a payment. Okay, we have, even if it's like for a loan to buy a car, if it's a loan to do something else, we have to establish a payment so that we know how to make that work. Okay? All right. Significant credit events. The VA is actually the loosest of all when it comes to significant credit events. They tend to be very flexible, whereas other loans are not. So bankruptcy, for example, 2-year discharge date, short sale and foreclosure is 3 years. That's actually pretty nice to have that, the waiting period from there. And then you can do it after Chapter 13. This is where we run into a lot of situations on a Chapter 13, because theoretically speaking, they could go out after being in a Chapter 13, after making 1 full year of successful payments in a 4-year program. Okay. The problem is that you as the realtor have to provide an executed contract to the trustee, and we have to provide loan documents showing that they can afford this house to get the trustee to sign off on it and make it work. It takes about 60 to 90 days for the trustee to receive those documents and approve them. And I don't know of any seller who's willing to take the risk these days in order to make something like that work in order to buy it. Okay. Now, back in 2013, 14, during the dark days, there were a lot of those. But right now, you're not going to see a whole lot of it. Okay. All right. Moving on. Properties and appraisals. There is an appraisal requirement. The appraisal, unlike FHA, which the FHA case number follows the property. In this case, the VA case number that we do follows the person. So it's not attached to the property like the FHA. Here's why that's a nuance that's important. With FHA, if you went to rebuy that house with an FHA 6 months later, that's when that appraisal finally expires and you no longer have to use it. If you try to buy it at a 3-month mark, now you have to pay attention to that old appraisal and that old case number. Why is that a problem? Well, 90 days in this market is a difference between $15,000 in purchase price, right? And that's a big deal. That's a really big deal as far as being able to make that work. So keep in mind that that's not something that follows with the VA, whereas with the FHA it does. Okay. Condos, getting back to condos. Condos is an idiosyncrasy of pretty much every loan. The VA will do spot approvals on non-warrantable condos. In other words, they're not approved through the VA. But I'm going to tell you that it is a little hard to get done with a condo. The condo has to be in pristine shape in order to be able to do that. And you have to be in a situation where everybody's current on their homeowner association dues and all sorts of things like that. Now, the reason why condos are such a big deal is you got to remember a couple of weeks back, the whole thing in Miami, right? Where that condo now they lost the entire building, but it was really only one side of the building that was affected. You guys remember that? Everybody lost the house, but only half of the building was actually collapsed. That's why a condo is so different for FHA, VA, conventional, because if something happens to one unit, it affects the entire building. So if they're behind on their homeowners association dues, now all of a sudden they don't have enough to fix the roof, to fix the siding, to fix those. You see what I'm saying? And so that's why the condos tend to have a little bit bigger issue when it comes to this. And I think that was it. No consideration given to the furniture, blah, 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 blah. I could go on longer if you want, but I think we're done unless you guys have any additional questions. Yes.
You said, you're talking about condo, how about the townhouse? Is it the same thing?
Townhouses are not the same.
It's not, okay.
Because with a condo, if there's 50 units in that building, you're 1/50th of an owner of that entire property. Whereas in a townhome, you actually own that strip of land that goes underneath the house.
Yeah.
Okay.
Let me clarify a little bit too, because townhouse is more a style of home. Condo is a type of ownership. So you might have something that looks like a townhouse, but it's really a condo. And would still fall under condo rules for lending.
Right.
So you have to be very careful with a townhouse style property. Is it a single family home or is it
That's a great point. Just so you kind of know what he's saying here, for those of you online that may not have heard that. The condo is more of a property type, and ownership style versus property type. And so what that means is if you go up into Gray Oaks, for example, Everybody been around in the Gray Oaks area? Or Charter Colony? You guys know Charter Colony? There's a little section called the villas, okay? They're single families with their own garage and their own driveway, but those are all condos. And so they all pay into the condo association for that piece. And it's looked at as one big piece of land, is how it's looked at. And so they may be, just to maximize this point, condos don't necessarily mean up and down looking like a beehive. It could be other things as well. Okay. All right. Any questions? Any thoughts? You have something about Tidewater? The what? Oh, Tidewater. Yeah. So this is an important piece for the appraisals. So Tidewater for the appraisals is when the appraiser is recognizing that they're not going to be finding value in the property. So let's say Michael has a property listed, he has it listed at $400,000, and at that $400,000 mark, the appraiser goes out and looks at the home, and he knows right away that he's not going to meet that $400,000. They will send us a note, and also to the agents, saying we're invoking the Tidewater. And in the Tidewater, what in essence is they're saying is they're giving us a heads up that this thing's not meeting value, and that we have to, in essence, provide additional comps in order to try to help overcome that notice. They don't usually do that in FHA. They don't do it in conventional. It's just in the VA. Giving you a heads up that it's going to come in low is really, in essence, what it is. So is that what you wanted to hit on? Yeah. Okay. So that's kind of, that's with appraisals. That's specific to the VA. Okay. Any other thoughts, questions, comments?
Question.
Yeah.
So I'm actually working with a client now that has a VA loan, and I see if when there's properties that she's interested in, when I check the MLS, I'm seeing a lot of times no VA. Like it's saying it's basically saying a lot of no FHA, no VA. Is that because even though it may look like a single family home, maybe it's linked to some type of?
Not necessarily. So this is where I started off earlier today when I said that the VA loans many times are unnecessarily maligned. Because in the appraisal, so let's go back to this slide right here. Go back to the appraisal slide, if I can get back there. The appraisal slide tends to be the biggest issue with most people that are selling homes. Because they're going to do, with the appraisal, they're going to do what is called a head and shoulders inspection into every space. And they also have to do an inspection that's above and beyond what you would find in conventional loans. Because if it's there, it has to work, where that's not necessarily what happens with conventional loans. And also there are certain minimum, what they call safety and livability concerns that they have that others are not going to have. Now, if the home is in good shape and they're saying no VA, no FHA, they're actually discriminating against very good buyers. But in some cases, the condition of that home is not going to pass an FHA inspection or a VA inspection, because they're going to require, for example, if there's any rotted windowsills or a deck that might have a board that's rotting, or they might have a visible sign of deteriorated paint on the exterior of the home where it's flaking. The VA is, when they're doing their inspection, they're going to point that stuff out because it affects the value and it affects the condition based on how the VA looks at their appraisals. Because of that, those items have to be fixed, have to be corrected prior to settlement, and you're not closing without it like that. Sometimes you can get away with it with a conventional, and so that's where you have to look at it from the standpoint of is it a condition that's affecting it, or is it something that is a preference? Okay, and if it's a condition that's affecting it, they may be right. They may not be able to get the funding done, especially if the seller is not willing to do any of the repairs, because that doesn't work out. Now, just to let you know, in this market, what we've done to overcome some of these is the buyer has been able to say, I know you're not accepting this, but these are the items that we're seeing that wouldn't pass the VA inspection, and I'll fix them right before closing. You just got to let me in. Okay. Now there's significant risk with that. And so you need to make sure that you're not putting your people in undue risk. And here's what I mean by that. We had a client I had a client recently who was misinformed by they didn't even tell me there was a problem with the house. They didn't tell me there was a problem with the house. And they went in, and this house, in essence, when I got the appraisal, was missing the lower level bathroom and the upper bathroom. It was missing drywall. It was all sorts of problems. It was about probably $7,000 to $10,000 worth of work. This agent convinced the borrower to go in and do the work, didn't bother telling me about it, to go in and do the work, and never got anything in writing from the seller stating that they were okay with it and that they would reimburse them if the home didn't close. Well, as soon as they finished doing the work on the property, the seller got into a match with the buyer and ended up rightfully canceling the contract. That buyer lost $8,000 worth of work that they did on this house. The seller went out, took the house, and sold it for $15,000 to $20,000 more because now the house was worth it. You see what I'm saying? So now, so don't just kind of go out and do this. If you're going to do this, make sure you're protecting yourself. But in this case, if the house is lacking in those areas, many times that's the only way to get that buyer into that house. Okay.
This is making more sense to me because the homes that she's looking at are like 160 and under.
Yeah.
And that's if they need work. And
Yeah.
so that's probably why it's saying no. Okay.
Right. And so if you're dealing with a HUD foreclosure or anything like that, it's not worth the risk.
Okay.
It's not worth the risk. Okay. Did that help?
Yes.
All right. Well, thanks for coming, guys. Thanks, everybody online. Thanks for coming.
Thanks, Chris.
Thank you so much.
Thank you.